What's up, guys? Your boy Quick Stocks is back. As always, remember to hit those thumbs to recharge my dopamine, and we will get right into your quick stock analysis of
Who's that company? It's
Shopify, ticker symbol SHOP, trading for 800. Are you for real? Yup, that's right. Shopify is trading for $825 a share as of May 25th, 2020, equating to an $88 billion market cap, up nearly 200% in the last year and just shy of 3,000% in the last 5 years. Meaning, had an investor put $10,000 into Shopify 5 years ago, it would now have a value of over $300,000. So, what's the move? Is it too late to add Shopify to our cart? Or is it time for us to head to checkout? This is your quick stock analysis. So of course, Shopify is a cloud-based shopping cart solution that helps individuals and small businesses set up shops online, build their brand, and of course, Shopify also offers shipping, digital payments, and fulfillments. However, Shopify's core business is the monthly billed e-commerce system aimed at small businesses and merchants that sell on the Shopify platform, where Shopify collects a small payment through their system gateway. And no one can argue that they've done a fantastic job convincing small businesses to sell stuff on their platform. However, this means when small businesses are hurting, Shopify will feel the ripple effects. And this is why they are working as fast as they can to support merchants by retooling their projects to help them adapt to the new reality. And while we're at it, it's important to note that Shopify is expanding its business as they've recently invested a massive $1 billion into building out their fulfillment network, which will make it so merchants can compete with Amazon's 2-day shipping. Speaking of Amazon, what is the difference between the two?
The way that company executives at Shopify like to talk about it is that other companies out there, Amazon, are building an empire, whereas Shopify sees themselves as arming the rebels.
But for real, enough shopping around. Let's get back to your quick stock analysis and take a closer look at the technical evaluation of the company. It's important to note that Shopify trades like it is on a flash sale. It is well traded for a company of its size, with roughly 3.5 million shares bought and sold on average daily. But you gotta understand, the reason we've seen such a massive run up in share price is because Shopify has a strong institutional backing. As of March, 1,179 funds owned the stock. And don't get me wrong, I'm not dismissing individual investors' role in running up the price and producing hype, but without massive institutions pumping billions of dollars into the company, there's no way a run-up like this would be possible. Which is kind of bizarre from a technical standpoint, as it certainly looks like Shopify is overvalued. But perhaps these large institutions know something the average investor simply does not. So I guess, as this is a quick stock analysis, we should take a closer look at the numbers. But remember, at $825 a share, Shopify is trading on hype.
It doesn't matter what you think!
So I'll be for real. From the outside, Shopify's balance sheet looks impeccable. Shopify's current ratio, which for those of you who may not know, is a financial metric calculated by taking a company's current assets divided by current liabilities, which gives Shopify a current ratio of nearly 9.5. And typically, a company with a current ratio of 1.222 is considered to be a financially healthy company. This means Shopify has nearly 9.5 times more current assets than liabilities. And when we look down at Shopify's net operating cash flow, as we can see here, Shopify made $70 million from their total operating income, which is the net income after paying operation expenses. Yes, this certainly means Shopify is at no risk of going bankrupt. And yes, this means Shopify could pay off all of their liabilities, making them completely debt-free, and still have billions of dollars in cash and assets. You have to give Shopify props where it's due. However, it's not all half-off rubber dog boots at Shopify. In actuality, Shopify had a net loss of nearly $125 million in 2019, which is almost a 2x increase from 2018, where we see Shopify had a net loss of $64.5 million. One has to wonder, how can Shopify have a net loss of $124 million in 2019 and yet still see a year-over-year positive net operating cash flow? Perhaps Shopify's balance sheet is not as squeaky clean as their product description paints, as when we look closer, we notice nearly $2.5 billion of Shopify's revenue came from investments in the sale or maturity of marketable securities. A common example of marketable securities includes stocks, bonds, CDs, or commodity contracts, which from the outside may not seem that bizarre, as investing in marketable securities are typically much preferred over to holding cash in hand because investments provide returns and therefore generate profit, whereas cash actually loses value due to inflation. And when you look at companies like Apple, who has approximately $208 billion in marketable securities, it makes Shopify's $2.5 billion in marketable securities look abysmal. However, the difference is Apple's foundation has already been laid, where one could certainly argue Shopify is still in the process of laying its foundation. An investor should certainly wonder why Shopify's management is choosing to invest a majority of their money into marketable securities rather than back into the company. And who knows, maybe Shopify has a grand plan.
Arming the rebels.
However, you know how we were talking about Shopify's operating expenses being negative, and yet the company is somehow cash flow positive? Well, we found the key. I'll make this quick, but for real, hear me out. This is important to understand before opening a position in Shopify. In the last 3 years, well over $2 billion of Shopify's revenue came from the proceeds of diluting share prices. Seriously, look at how much of Shopify's revenue has come from diluting shares, or in other words, issuing new shares to the public. And you may be asking yourself, why is this bad? Well, when a company does this, it reduces the value of previous shareholders. Which, don't get me wrong, clearly it has worked out for Shopify, and I can't imagine many shareholders are complaining, considering the massive growth investors have been a part of. However, you have to take this into consideration. The company is not generating a profit, and as the revenue for the company increases, so do the losses. And the only reason Shopify, historically, have reported decent earnings is due to them issuing new shares, which one could certainly argue this is due to Shopify focusing on growth, which has clearly worked out so far, as Shopify has become Canada's most valuable publicly traded company. So with all of this in mind, what's the move? I say duck it. Who needs money when you got dopamine? And clearly Shopify is giving investors that sweet dopamine drip. But for real, a proper technical analysis of Shopify would go along the lines of: the stock has been acting bullishly in the pandemic market. However, Shopify has rapidly extended, meaning shares are not in a proper buy zone. Investors should wait for Shopify to form a new base or pull back to the 50-day moving average. Alright, I'll stop joking for 1 second. For transparency's sake, I can't see myself starting a position in Shopify, at least for the foreseeable future. It is a great company, but after taking into consideration everything that's been talked about in this video, honestly, I don't think it would be a good fit for my portfolio. Anyways, guys, that's all we've got for today. This was your reporter, Quick Stocks. As always, the best investment you can make is to go long on Quick Stocks. Hit that subscribe button at 255 subscribers and plan an early retirement. I will catch you guys in the next one.